So here we have the different ways we could figure out or calculate the intrinsic value of a common share. So the first one is the dividend discount model, and that's just where you take all the future projected dividends and you discount them back to a present value today. Just like we did with the bond, we discounted all the future coupon payments back to a present value today. There's a corporate valuation model where you figure out the value of the total market value of the corporation and then you back into what the price per share should be. There's the price earnings multiple approach. That's good for companies that don't pay any dividends. You can't really use a dividend discount model if the company doesn't pay dividends. So if you have an estimate of a future PE ratio, you can use that with an expected earnings per share for the next year and multiply the two and you would get a price. So it's like another way to find a price. And then there's the economic value added approach. With the economic value approach, you are going to look at how companies increase their economic value added by investing in projects that provide shareholders with returns greater than the cost of capital. So when you purchase a firm's stock, you receive more than just the book value of equity. You also receive a claim on all future value that is created by the firm's managers. So a company's market value of equity equals book value plus the present value of all future economic value added. This value can be taken and divided by the number of shares outstanding to arrive at an estimate of the stock's intrinsic value. So the discounted dividend model, or we usually call it the dividend discount model, is just saying, like I mentioned before, take all the future expected dividends and then discount them back at the required rate of return. And then you should find an intrinsic value for the stock. And again, once you find that intrinsic value, you can decide, is it an undervalued stock, which you should buy, or an overvalued stock, which you should sell. Now, in many cases, you can't just have like a different growth rate for every time period because companies are growing like maybe at 20% one year, then 10% another year, then maybe 5% another year. So something that makes this process easier of finding the present value or the intrinsic value of a stock is just to use the constant growth model. And we can find future dividends by taking the present dividend, this is like the dividend that was just paid, D0, times 1 plus a growth rate. Because at some point in a company's life, we just have to make an assumption that dividends are going to continue to grow at a constant rate forever. And so you can find dividend 2 by taking D0 times 1 plus the growth rate squared. So this is just like future value equals present value times 1 plus I raised to the n. So if you can assume that there's a constant growth rate, then this price formula is converted to a short formula that's easy to use. And you can see here it's stated two different ways. If you have the dividend just paid, D0, then you multiply that times 1 plus G, because you really need D1, which is in this second way that the equation is stated. And it's all divided by R minus G. And this is just they arrived at this by some mathematical long computations. And they said, well, basically that previous equation here, if we assume a constant growth rate, just reverts to this simple equation here. And so that's pretty good news because it is a simple equation. And then this is just kind of an odd slide, but it shows you that as you are finding future values of dividends, they're going to be increasing. And then when you find the present value of dividends, that's going to be bringing their dollar value as you go out into the future closer to zero. So dividends that are paid way, way, way out into the future really don't count much towards the price of the stock. But dividends that are paid more recently do count much more in terms of the price of the stock. So in that equation, D1 over R minus G, we assume that R is going to be greater than G, because otherwise we have a negative price. So this is the situation they're talking about here. If the growth rate is greater than the required return for the stock, then you do get a negative stock price and you can't use that model. So you can only use the model if the required return for the stock is greater than the growth rate, and if the growth rate is going to be constant forever. So you can't have a negative stock price. So if you remember the CAPM, also known as the security market line, we can use that to calculate the required rate of return for a stock. And so the equation we were just learning about in the last chapter is RS is equal to the risk-free rate plus the market risk premium times beta. And so if they give you this these assumptions, if the risk-free rate is 7%, then we plug that in to wherever we have the risk-free rate. Return on the market is 12 and the beta for the stock is 1.2. What's the required return for the firm stock? And so you see that we get 13%. So now we have R, something we can use in our valuation to find the intrinsic value of the stock. And then here's an example just looking at how to find future values of dividends. They said let's assume that the growth rate is constant at 6%. And so if you start out with a dividend that was just paid that was $2 per share, to get the dividend at time 1, it would be $2 times 1.06. So you get $2.12 for the dividend at the end of year 1. And then if you multiply this times 1.06, then you get $2.25. And then if you multiply that again, you would get $2.38. And then they said, well, let's use that required rate of return of 13% to discount these dividends back to the present, because eventually we need the sum of all the present values of the dividends. And so let's assume that we were able to say this was a constant growth rate of 6%. We go back to our equation, the constant growth model, and we put D1, which was $2.12. If I go back, we got $2.12 by multiplying 2 times 1.06 over R minus G. And we had calculated the required rate of return, and they gave us a constant growth rate of G. And so we divide that, and we should get $30.29. So that's the intrinsic value of the stock. And so if this was for AT&T, then I would believe that that stock is worth $30.29. And I would look at Yahoo Finance and see what is the current market price. So let me go to Yahoo Finance and find out what it is for AT&T. And so the ticker symbol, you go over here to the quote lookup, it's just T for AT&T. And I see that the current price is $34.50. So if I go back to my PowerPoint, I believe it's only worth $30.29. So I would say that this stock is overvalued, and I wouldn't want to pay $34 for a $30 stock. So I would avoid this stock, or if I held it, I would believe it would go down to $30 and I would sell it. And if I was really risk seeking, I could short sell the stock, where I borrow this stock at $34 a share from my broker and I sell it in the market, and then I wait for the stock price to go down to $30.29 and I buy it back. And so I've made a difference on made a profit on the price going down. So those are some different things to consider if you have an overvalued stock. So we could find what's the expected value of the stock 1 year from now. And all we would have to do, well, there's two different methods. The most logical method to me is If you already have the price like we had, $30.29, $30.29 and just increase it by the growth rate of 6% is $32.10. Or you could look at this method. The way that you get an estimated price in the future is if this is P1, then you need D2 in the numerator. If this was P2, you would need D3. So this is like the estimated price of the stock at time 1. And so we need D2 over RS minus G. And on that previous timeline, we had D2 estimated at $2.247. And then we have R minus G, and we get the same thing, $32.10. So this is the quicker method if you already have the price. If you don't, you can use this equation right here. Remember from the bond chapter how we had the total return for the bond was made up of a current yield plus a capital gains yield. And I mentioned dividends back then. Well, now we're talking about this in the same way, but just talking about a stock. So a stock has two components of return, a dividend yield and a capital gains yield. If the stock doesn't pay dividends, then the total return is just going to be a capital gains yield. An example of that would be when I owned not AT&T, it was Apple stock before they started paying a dividend. Anything that I made was just a capital gains yield. But now with Apple, it pays a dividend yield, so the two components of its return is the dividend yield plus the capital gains yield. And you can see down here we have the total return is equal to the sum of those two. For the example numbers that we had before, the dividend yield is always D1 divided by P0. So it's the next expected dividend divided by the current market price. And what we had was $2.12 for the next expected dividend and $30.29 for the the intrinsic value or the price we think it's worth today. And so if we divide those two, we see that stock would have a dividend yield of 7%. And then the capital gains yield could be found by finding the percentage change in the price. So we take the next year's expected price, $32.10, that we had already calculated, minus the intrinsic value today divided by what we expect the intrinsic value today to be. And that's 6%. Now you could also, if you look down here, since the 7 and 6 sum up to equal 13%, which remember that 13% was the required rate of return for the stock, and that makes sense. If we calculated the dividend yield and we knew the required rate of return, we could back into the capital gains yield. So we could say 13% minus 7% would be equal to the 6%. And that's just because this is an equation, they have to sum up to equal that required return.